Welcome back to the Hub, where you will always find up-to-date real information around any and all cryptocurrency markets. If you have not already, please like and subscribe, as our goal is to bring real-world financial insight and macro clarity to everyone navigating this evolving asset class. XRP holders are walking into a trap, and the danger is not rooted in panic or collapse. It is rooted in misinterpretation. The market structure is shifting beneath the surface, and positioning is increasingly disconnected from the broader macro liquidity environment. This phase is not dramatic, it is structural, and structural shifts are where capital is quietly redistributed. The global macro backdrop has entered a late cycle transition. Inflation across developed economies has moderated from its peak, yet underlying pressures remain embedded in wage growth, fiscal expansion, and services inflation. Central banks are no longer tightening aggressively, but they are not easing decisively either. This creates a liquidity plateau. Liquidity is no longer expanding rapidly, but it is not contracting in a disorderly fashion. In these environments, asset repricing becomes selective rather than explosive. Bond markets are reflecting this uncertainty. Sovereign issuance has surged as governments refinance record deficits, and higher for longer rate expectations continue to pressure long-duration debt. When sovereign supply increases, capital is absorbed by safer yield instruments before flowing into risk assets. That absorption matters for crypto. Risk assets do not rise in isolation. They rise when excess liquidity searches for a return beyond traditional markets. At present, liquidity is cautious. Institutional allocators are managing risk exposure carefully. They are not chasing narratives, they are calibrating duration, volatility exposure, and regulatory clarity. Within that framework, XRP is being priced in a transitional macro regime. Retail holders often interpret price resilience as imminent breakout potential. Institutions interpret range-bound behavior as unresolved structural confirmation. That distinction defines the trap. The crypto market is no longer in a pure speculative expansion cycle. It is transitioning toward institutional integration. During speculative phases, narratives dominate price action. During integration phases, capital deployment is incremental and compliance-driven. XRP sits at the center of this transition. Its thesis is not built on meme momentum or speculative decentralized finance cycles. It is built on cross-border settlement, liquidity provisioning, and institutional-grade infrastructure. That thesis requires time. It requires regulatory harmonization. It requires integration into existing banking rails and payment corridors. Retail positioning, however, is forward-loaded. Expectations for rapid institutional adoption have been priced in repeatedly over multiple cycles. Each regulatory development or partnership announcement has generated bursts of optimism followed by consolidation. This pattern is not accidental. It reflects the difference between announcement cycles and implementation cycles. Implementation cycles are slow. Financial institutions operate under capital constraints, compliance frameworks, and counterparty risk assessments. Even when infrastructure is technologically ready, balance sheet integration moves gradually. At the macro level, global liquidity conditions reinforce this caution. Central banks remain sensitive to inflation reacceleration. Fiscal deficits remain elevated. Geopolitical fragmentation continues to reshape trade flows and reserve allocation strategies. When macro uncertainty is elevated, institutional capital prefers optionality over aggressive deployment. That means pilot programs instead of full-scale adoption. It means testing liquidity corridors before committing substantial volume. For XRP holders expecting rapid parabolic repricing, this creates friction. Price consolidates while the structural thesis slowly matures. From a technical standpoint, XRP remains within a broad macro range. Major liquidity pools sit above previous resistance clusters, while demand zones remain intact below recent consolidation lows. Each approach toward resistance has been met with supply absorption. Repeated resistance testing without decisive breakout reduces the probability of immediate upside continuation. Instead, it increases the likelihood of volatility sweeps designed to clear leverage. Leverage is quietly building across the crypto market. Funding rates periodically spike during bullish sentiment waves. Open interest expands during consolidation. These are early indicators of positioning imbalance. When positioning becomes one-sided, markets move against consensus to reset exposure. This is how traps are formed, not through collapse, but through controlled volatility. The broader crypto ecosystem is experiencing internal rotation. Capital is flowing into tokenization narratives, infrastructure providers, and institutional custody platforms. This rotation reflects a maturation process. Crypto is being repositioned from speculative asset class to digital financial infrastructure layer. That transition reduces explosive upside frequency but increases structural credibility. For XRP, credibility is central. Its long-term value proposition is tied to its function within cross-border settlement and liquidity bridging. That function becomes meaningful when integrated into real transaction flows. However, transaction flow scaling is gradual. It requires regulatory clarity across jurisdictions, interoperability standards, and banking partnerships that move through compliance committees before moving through capital markets. This timeline often conflicts with retail time horizons. XRP holders who entered during high volatility breakout phases may be conditioned to expect rapid repricing, but the current macro regime rewards patience and structural alignment rather than immediate momentum. That is the core of the trap. Expectation without macro alignment leads to mispositioning. In the current environment, global capital is recalibrating. The US dollar remains structurally strong relative to many emerging market currencies. Sovereign yield differentials continue to attract capital into traditional instruments. Until central bank balance sheets expand decisively again, risk assets will likely experience episodic rallies rather than sustained vertical expansions. Crypto rallies during liquidity plateaus tend to be narrative-driven and short-lived. Sustainable expansions require systemic liquidity acceleration. XRP's resilience during consolidation is not inherently bearish, but resilience without volume expansion and institutional flow confirmation is not inherently bullish either. The market is compressing. Compression phases reward disciplined accumulation strategies and punish leveraged impatience. For crypto broadly, this matters because the industry is navigating regulatory maturation. Jurisdictions are defining digital asset classifications, compliance requirements, and custody standards. Regulatory clarity reduces existential risk, but increases compliance costs. Increased compliance slows rapid experimentation, but strengthens long-term viability. XRP's positioning within this evolving framework is unique. It has navigated significant legal scrutiny, and that process has provided a degree of definitional clarity relative to many other digital assets. Yet clarity does not automatically translate into institutional floodgates opening. Institutions require alignment between regulation, risk modeling, liquidity depth, and revenue justification. That alignment is progressing, but it is not instantaneous. The macro trap is subtle. Retail participants see regulatory progress and anticipate exponential adoption. Institutions see regulatory progress and begin measured integration. Measured integration does not create parabolic charts. It creates steady groundwork. As the market oscillates within defined liquidity bands, sentiment becomes increasingly reactive. Each minor breakout attempt generates optimism. Each retracement generates doubt. This emotional oscillation is the breeding ground for capital misallocation. Understanding the liquidity cycle reframes the narrative. Global liquidity is not in expansion mode comparable to post-2020 stimulus conditions. It is in stabilization mode. Stabilization produces consolidation, not mania. XRP holders must evaluate positioning through this lens. The asset is not failing. It is maturing within a cautious macro regime. That maturity phase can last longer than anticipated. The question is not whether XRP has long-term structural potential. The question is whether current positioning reflects realistic timelines for institutional scale. That is where many holders are misaligned. The event landscape surrounding XRP continues to evolve. Cross-border payment initiatives are expanding incrementally, tokenized asset pilots are increasing, and central bank digital currency research is accelerating across multiple jurisdictions. These developments reinforce the broader thesis of blockchain-based settlement integration. However, integration is occurring within tightly controlled regulatory environments. Financial institutions are experimenting with distributed ledger technology to reduce settlement friction, improve liquidity efficiency, and optimize collateral mobility. These experiments validate the technological direction of the industry, yet validation does not equal immediate volume migration. Traditional correspondent banking networks remain deeply entrenched. Transitioning even a fraction of global settlement flows requires operational overhaul. This is where the trap intensifies. Retail investors interpret technological validation as immediate displacement of legacy systems. In reality, displacement occurs gradually through hybrid models. Hybrid models mean coexistence. Legacy rails continue operating while blockchain rails expand corridor by corridor. For XRP, corridor expansion is critical. Its utility increases as more institutions connect to its liquidity network. but corridor growth is measured, compliance-driven, and dependent on regional regulatory cooperation. Global geopolitical realignment also plays a role. Trade fragmentation, sanctions regimes, and regional currency blocks are reshaping cross-border capital flows. Some regions are exploring alternatives to traditional settlement systems. This creates long-term opportunity for neutral bridge assets. However, geopolitical shifts also increase regulatory scrutiny. Governments are cautious about payment systems that could circumvent capital controls or sanctions frameworks. Therefore, digital settlement networks must operate transparently within regulatory boundaries. This environment favors assets capable of institutional integration rather than ideological decentralization. XRP's alignment with enterprise partnerships positions it structurally well. But structural positioning does not guarantee rapid repricing. From an institutional perspective, the decision to allocate capital into digital asset infrastructure is strategic. It involves internal committees, compliance audits, cybersecurity assessments, and capital allocation modeling. Each step introduces delay. Delay reduces speculative velocity. This is why price often moves ahead of fundamentals during early cycles and then stalls while fundamentals catch up. The crypto market overall is experiencing this catch-up phase. Institutional custody solutions have improved. Accounting standards are evolving. Exchange-traded products are expanding. Yet systemic exposure remains a small fraction of global capital markets. Until pension funds, sovereign wealth funds, and major banks allocate meaningful percentages of portfolios, digital assets remain emerging allocations rather than core holdings. XRP's institutional thesis depends on becoming embedded in payment infrastructure rather than held purely as a speculative asset. That embedding requires transaction flow growth. Transaction flow growth depends on trust. Trust depends on regulatory clarity and operational reliability. Operational reliability is being tested continuously. Network uptime, liquidity depth, and compliance integration must prove resilient across stress scenarios. Stress scenarios include macro shocks, liquidity squeezes, and regulatory disputes. Assets that survive stress attract institutional confidence. Therefore, short-term volatility does not invalidate the thesis, but it can trap over-leveraged participants. The short-term outlook for XRP remains structurally range-bound unless a clear liquidity catalyst emerges. Catalysts could include coordinated central bank easing, significant institutional deployment announcements tied to measurable transaction volume, or regulatory harmonization across major financial hubs. Absent these catalysts, price is likely to oscillate within established liquidity bands. Upside attempts may be sharp but unsustained if not accompanied by structural volume expansion. Downside wicks may clear support temporarily but recover if long-term holders maintain conviction. Volatility expansion events are most likely around macro inflection points. Federal Reserve policy shifts, bond yield spikes, or geopolitical escalations can ripple through risk assets rapidly. In such events, crypto correlations tend to rise rather than fall. XRP would likely move in tandem with broader market stress initially, regardless of its unique thesis. Longer term, however, structural differentiation becomes more relevant. If global finance continues transitioning toward tokenized securities, digital settlement rails, and programmable liquidity, assets integrated into those rails gain structural relevance. Tokenization of real-world assets is accelerating. Government bonds, money market funds, and private credit instruments are increasingly being tested on-chain. These developments indicate that blockchain infrastructure is moving from peripheral to central experimentation within finance. As tokenization scales, the need for interoperable liquidity layers increases. Fragmented tokenized ecosystems require bridging mechanisms to function efficiently. XRP's architectural design aligns with this bridging requirement. Its speed, settlement characteristics, and focus on liquidity provisioning position it within that narrative. However, the narrative must be supported by measurable adoption metrics. Volume growth, institutional onboarding, and corridor expansion must be observable. The trap emerges when narrative anticipation exceeds measurable expansion. Long-term success for XRP is more likely under gradual institutional integration rather than systemic financial collapse. A collapse-driven reset would create broad volatility and unpredictable regulatory backlash. Gradual integration, by contrast, allows regulatory frameworks to mature alongside technological deployment. Under gradual integration, price appreciation tends to be stepwise rather than vertical. Breakouts occur when structural thresholds are crossed, not when sentiment peaks. Therefore, disciplined accumulation during macro consolidation can be strategically rational. Leveraged speculation during consolidation can be strategically destructive. The macro synthesis is increasingly clear. Liquidity remains cautious but not restrictive. Institutions are exploring but not fully deploying. Regulation is clarifying but not globally harmonized. In this environment, patience becomes a competitive advantage. XRP holders who align expectations with macro pacing are less likely to be caught in volatility sweeps. Those who assume immediate exponential adoption risk emotional exhaustion. Markets reward those who understand cycle timing. The current cycle is integration, not mania. XRP's structural role within the evolving global financial architecture remains credible. It is positioned within cross-border liquidity discussions, tokenization frameworks, and institutional blockchain experimentation. But credibility must convert into capital flow gradually. The trap is not that XRP fails. The trap is that holders misjudge the timeline. Liquidity cycles dictate opportunity windows. When global liquidity expands aggressively, risk assets surge. When liquidity stabilizes, assets consolidate while infrastructure builds. We are in infrastructure build mode. Understanding that distinction changes positioning strategy entirely. The final layer of analysis requires stepping back and examining capital flow dynamics at the highest level. Global liquidity is shaped by central bank balance sheets, commercial bank lending standards, fiscal deficits, and cross-border capital movement. When central bank balance sheets expand decisively, excess reserves filter into financial markets. Risk appetite increases, correlations loosen, and speculative cycles accelerate. When balance sheets stabilize, capital becomes more discerning. Yield competition from sovereign debt instruments increases. Institutional allocators prioritize risk-adjusted return over narrative exposure. Currently, global balance sheet expansion is measured rather than aggressive. This constrains the speed of speculative upside across crypto markets. At the same time, fiscal expansion continues to inject liquidity indirectly through government spending. This creates a complex environment where liquidity is present but not freely speculative. Within that complexity, digital asset infrastructure continues maturing. Custodial standards are strengthening, reporting frameworks are improving, institutional-grade trading venues are expanding. These developments are foundational. Foundations are not glamorous, but they are necessary. XRP's long-term function within this architecture hinges on interoperability and liquidity efficiency. If cross-border settlement increasingly leverages digital rails, bridge assets gain strategic importance. If tokenized securities require real-time settlement across jurisdictions, liquidity layers become indispensable. However, indispensability must be demonstrated empirically. Institutional capital does not allocate based on potential alone. It allocates based on risk modeling, revenue generation, and operational consistency. Therefore, the structural path for XRP is incremental integration leading to eventual network effect scaling. Network effects in financial infrastructure build slowly, then accelerate. But acceleration only occurs after critical mass thresholds are reached. The current market phase suggests we are still in pre-threshold accumulation. Short-term volatility should be interpreted through this macro framework. Price spikes without macro liquidity expansion are vulnerable. Corrections within structural ranges are not thesis invalidations. Risk management becomes central. Position sizing, leverage control, and expectation alignment matter more than prediction accuracy. The broader crypto market will likely continue oscillating between optimism and caution as macro signals evolve. XRP will participate in that oscillation. But beneath volatility, infrastructure continues building. The global financial system is not static. It is gradually digitizing. Settlement inefficiencies are being identified. Liquidity fragmentation is being addressed. In that transformation, assets designed for interoperability have structural relevance. The ultimate synthesis integrates 4 pillars: liquidity dynamics, institutional positioning, regulatory evolution, and technological integration. Liquidity dynamics determine timing, institutional positioning determines scale, regulatory evolution determines viability, technological integration determines functionality. XRP intersects all 4 pillars. If liquidity expands meaningfully in the next macro phase and institutional pilots convert into scaled deployment within clearer regulatory frameworks, XRP's structural thesis strengthens significantly. If liquidity remains plateaued and integration continues incrementally, price appreciation will likely remain measured. Neither scenario implies failure. Both imply patience. The trap for XRP holders is emotional acceleration in a macro deceleration phase. Understanding the phase removes the trap. Strategic positioning within evolving financial architecture requires discipline, macro awareness, and realistic timelines. Speculative urgency in transitional regimes leads to misallocation. XRP remains a structurally relevant asset within the conversation around tokenization, cross-border liquidity, and institutional blockchain adoption. Its long-term viability depends on execution, integration, and capital flow alignment. Execution is ongoing, integration is gradual. Capital flow alignment will follow liquidity cycles. Those who recognize this can navigate volatility with composure. Those who ignore macro context risk reacting rather than positioning. Markets move in cycles. Infrastructure builds between surges. Capital consolidates before expanding. This is a consolidation era. The opportunity remains embedded within the architecture being constructed. Understanding that architecture is the difference between walking into a trap and walking into a long-term strategic position. Thanks for watching The Hub and stay ahead of the market. We'll see you on the next one.